All right, so chapter 4, reporting and analyzing merchandising operations. Up until this point, we've really just looked at the activities of service-based organizations, and now we're going to kind of switch gears to merchandising and inventory type organizations. So let's dive in. All right, so the chapter 4 learning objectives, we're going to learn how the activities of a merchandising company differ from those of like a service-based company. We're going to talk about the inventory asset and the cost flows. We'll learn some ratios to analyze the businesses just like we do in every chapter. And then we will analyze and record transactions for merchandising companies using the perpetual system. And we'll look at the difference between multi-step and single-step income statements in this chapter. Okay, so first let's describe what the merchandising activities look like and identify the components of income for a merchandising company. All right, so when we're reporting income for a service organization, the service organizations sell time basically to earn revenue. So accounting firms, law firms, plumbing services, that kind of thing. And so when we're looking at an income statement for a service-based company, this is all stuff you've seen before. We have revenues minus expenses equals net income, right? Well, in a merchandising company, we have this thing called cost of goods sold. And so our income statement, we start with net sales less cost of goods sold equals gross profit minus expenses equals net income. Okay, so there's just another component to the merchandising company's income statement. Okay, let's talk about inventory assets and cost flows next. All right, so the operating cycle for a merchandiser begins with the purchase of the merchandise and it ends with the collection of cash from the sale of the merchandise. Okay, so you start with purchasing the merchandise, then you have merchandise inventory, then you have credit sales, then you have accounts receivable, and then you have the cash collection. Okay, so I think the best way to describe or I guess depict the idea of cost of goods sold is like this. So you have beginning inventory, you add your purchases to it, and that's what you call merchandise that's available for sale. And then you've got that merchandise available for sale goes one of two places during the reporting period. It either is still sitting in your ending inventory or you've sold it, which is what we call cost of goods sold. Okay? So there's two different kinds of inventory systems. There's perpetual systems. So every time you make a sale or a purchase, the system updates. And then there's periodic systems where the system's updated only at the end of the accounting period. Now, today, most companies are on perpetual systems because technology allows us to do that relatively easily. I don't know if I've ever, so my exposure, like we talked about at the beginning of class, in like week 1 maybe, or even the introductory meet session, my exposure with respect to inventory-based companies is really only on the audit side. So I've audited inventory-based companies. I have never worked for one, and there's a reason for that. Inventory accounting is terrible, but nevertheless, we have to learn it, and so here we are. But anyway, so what I was going to say is the periodic system, I don't think I ever saw that in the course of my, gosh, 4 or 5 years in public accounting. So anyway, for whatever it's worth, perpetual system's the most common. All right, so let's walk through this problem and see if it starts to make some sense. So using the following information, they want us to compute a couple things for the merchandise only company, cost of it, or goods available for sale, cost of goods sold, and gross profit. And then they want us to compute net income for both companies. And the hint that they give us is that not all the information may be necessary for the solutions. Okay? All right, so the first one we were asked to compute was the merchandise available for sale or goods available for sale, right? So in a slide a little while ago, we said that goods available for sale was equal to beginning inventory plus purchases, right? So 100 plus 80 is 180. Then we said that goods available for sale is also equal to ending inventory plus cost of goods sold. So you can compute the cost of goods sold one of two ways. So if we know that the goods available for sale oh gosh, hold on. We know the goods available for sale are $180. We know that's made up of ending inventory and cost of goods sold. That's supposed to be a G. We know that ending inventory is 50 bucks. So 180 less 50 must mean that cost of goods sold is 130. But there's another way to do that as well. The formula for cost of goods sold is equal to beginning inventory plus purchases less ending inventory equals cost of goods sold. So we have all those numbers too. 100 plus 80 minus 50 equals 130 as well, right? So they're using this approach to compute the cost of goods sold. The other way is a little bit of a shortcut. Okay, so our cost of goods sold is 130. Then the gross profit is equal to net sales of 190 minus cost of goods sold of 130. So our gross profit's 60. And then if we were to compute the income for each company, we would have our, from gross profit, we just subtract our expenses to get to $40 of net income. And then over here on the service company, it's just the same old like we've been doing for several chapters now. Revenues less expenses equals net income of 30. Okay, so hopefully that makes sense. All right, so now let's get into the meat of what chapter 4 is all about. So we're going to analyze and record transactions for merchandise purchases using the perpetual system. All right, so there's this idea of purchases, and you can have purchases with or without discounts. So oftentimes when you buy things from a vendor, the vendor will give you an incentive to pay your bill earlier. And we'll get into that, but for the purposes of this example, we're going to purchase some inventory for cash, basically. So on November 2nd, Zmart purchased $500 of merchandise inventory for cash. And so inventory is an asset account, and we know that asset accounts are increased with debits and they're decreased with credits, right? So you have an increase to your merchandise inventory for $500, and we're going to reduce our cash, $500. Okay, easy peasy. All right, so here's the idea of credit terms. So basically you can deduct from the invoice price some percentage that the vendor will tell you if you pay the bill earlier. So typically, if you pay it sooner, usually within 10 days or so, they'll give you a discount. And so I don't know if this slide's really all that helpful, but basically, let's say you have 30 days to pay the bill. Well, if you pay it in the first, I don't know, 10 days or whatever, they'll give you some kind of a discount. Okay? That's really all this is trying to say. So here's the way it's written, because nothing in accounting can be plain English, right? So this 2/10 n/30, this is not an algebra problem. It is also not 2/10 or 2 divided by 10 and n divided by 30. What it means is you get a 2% discount if you pay it in 10 days, or you pay the net, which is the amount of the invoice, in 30. Okay? So let's look at an example when we pay with cash discount. So on November 2nd, Zmart purchased $500 of merchandise inventory on account which means there's an AP, right? And the credit terms are 210 net 30. So when you first buy it, you record, because you didn't pay cash, you're going to increase your inventory by 500, and you're going to increase your account payable by 500. Account payable is a liability. You increase with a credit, right? Then, just to keep the suspense going, right? I know you're dying to know what we do when we pay it. Here's a picture of the invoice. Key information you care about: seller, invoice date, purchaser, order date, credit terms, freight terms, goods, total amount, net amount, okay? So here, like, here's the 210 net 30. So basically, if you pay it after 10 days, you pay $500. If you pay it within 10 days, you get to pay $490. So you save 10 bucks, okay? So that item we just purchased 2 slides ago, now when we pay it, and we're paying it within the 10 days, we bought it on November 2nd, we're paying it on November 12th, so we paid it within 10 days. So when we pay it, we get to take the discount. So you put an account payable on your books for $500, so you have to make that go away. But then you're only going to pay $490 of cash. Well, you got a problem, right? Debits don't equal credits. And so your plug, so to speak, to make your journal entry work is you just reduce your cost of your inventory by the discount that you ended up taking on it. Okay? So when you take discounts, the initial transaction you record at the gross amount, because you don't know whether you're going to pay it within 10 days or not. But when you pay it, and you pay it within that discount period, when you record the unwinding of your payable that you put on your books, and you record the cash going out the door, you just record the discount then, and you just reduce your inventory with a credit for the amount of the discount. Okay? All right. So payment with within discount period ledger accounts. So after we post the entries, these are our T accounts, just like we've been doing all along. So you have your accounts payable T account, your initial $500 on November 2nd on the credit side, then your payment, $500 on the debit side, so you end up with a zero balance, which is what you want. You want to recognize your $490 going out the door for your cash, and then your merchandise inventory, rather than the $500 being the cost of that inventory, it's now $490 because you got a discount. Okay? All right, if we have a payment after the discount period, let's say you don't pay it till December 2nd, then you just unwind like normal. You debit your accounts payable and credit your cash for the full payment. Okay? All right, so let's talk about purchases, purchase returns and allowances. So a purchase return is basically merchandise that a buyer purchases but then returns. Okay? So a purchase allowance refers to a seller granting a price reduction or an allowance to a buyer for defective or unacceptable merchandise. So when the buyer takes or returns, when a buyer returns or takes an allowance on merchandise, the buyer issues a debit memorandum to inform the seller of the debit made to the accounts payable in the buyer's records. So if you remember, debits reduce the liabilities, and we'll talk about that here on the next slide. All right, so if we assume that on November 5th, Zmart, the buyer, issues a $30 debit memorandum for an allowance from Trex for defective merchandise. So Zmart's November 5th entry is going to be to update its merchandise inventory account to reflect the purchase allowance that was issued. So they originally bought merchandise inventory for what, 500 bucks, and now they're saying, yep, there was a debit memorandum issued, and so we're going to reduce our inventory balance, and we reduce assets with credits, and we're going to reduce our accounts payable. Okay, because we originally had $500 debit to merchandise inventory, $500 credit to accounts payable, and now there's a debit memorandum for defective merchandise, and so we're going to reduce our payable by 30 bucks and reduce our inventory by 30 bucks. All right, so now if we look at returns, so returns are recorded at the net cost that was charged to the buyer. So if Zmart purchases $250 of merchandise on June 1st with terms 210 net 30, On June 3rd, Zmart returns $50 of goods before paying the invoice. And then when they pay it on June 11th, they take the 2% discount only on the remaining $200 balance. So here's what that would look like. So here's their initial purchase right here on June 1st. Okay. So we bought inventory, debit inventory for $250, credit accounts payable. Then here's that debit memorandum for $50. Or I'm sorry, back up. They returned $50 worth of goods. So you just do the opposite for the amount that was returned, right? So you reduce your payable by $50 and you reduce your inventory by $50. Then when they make the payment on June 11th and they take the 2% discount, they have to take the 2% discount on only the remaining $200 balance. Because if we were to look at our T account for inventory, we have the original $250 here, right? And then we have $50 here. And so before they pay the bill, they only have $200 balance, which is this right here. Okay. And so when they take the 2% discount, 2% of 200 is $4. So we're going to reduce our merchandise inventory by 4. And we're going to pay them $196 in cash. Okay. All right. So when you're a merchandising company, you have to agree, the buyer and the seller must agree on who's responsible for paying the freight or the shipping costs and who bears the risk of loss if the truck crashes in transits or something like that. Okay, so the way that's defined is these terms FOB shipping point and FOB destination point. And so FOB means free on board. It's a old school term. But if something is shipped FOB shipping point, the ownership transfers to the shipping point. So when the goods are in transit, that means they're owned by the buyer. And when they're owned by the buyer during transit, shipping point, buyer, the cost of the freights or the shipping costs just becomes part of your merchandise inventory. But if it's FOB destination, meaning the ownership doesn't transfer until it reaches its destination, so the seller is responsible during transit, it's delivery expense on your income statement. Okay? All right. So if Zmart purchased inventory on the terms of FOB shipping point, that means that Zmart is responsible during transportation. It just becomes part of their inventory cost. So they record $75 to merchandise inventory and reduce their cash $75. Okay? All right, so when we're itemizing or figuring out the cost of our inventory, it's invoice cost, less purchase discounts, less purchase returns and allowances, plus cost of transportation in. So that's FOB shipping point costs, okay? That's how we compute our total net cost of merchandise purchases. So that's what's hitting your inventory account. All right, so let's do some journal entries. So prepare the journal entries to record each of the following transactions of a merchandising company. Assume perpetual inventory system using the gross method for recording purchases. So on October 1st, we purchased $1,000 of goods. Terms of the sale are 4% if you pay in 10 days, net if you pay in 30. And it's FOB shipping point, and the invoice is dated October 1st. So shipping point means that we're responsible for those charges, right? So, purchased $1,000 worth of goods. So, what do we debit? What do we credit? We debit inventory and we credit accounts payable for the gross cost, $1,000, right? Post it to our T account. Oh gosh, I didn't mean to show all of that, but apparently my animation is not 100% correct. So let's just roll with it. So pretend like you can't see it or something. All right, so then on October 3rd, we paid $30 cash for freight charges from UPS for the October 1st purchase. Well, so because it's FOB shipping point, remember, we're responsible for it, and it just becomes part of our inventory cost here. Okay, so we debit inventory and credit cash because they tell us we paid cash for it. Then on October 7th, we returned $50 of the $1,000 goods from the October 1st purchase and we received a full credit. So we're just undoing it, right? So you just reduce your payable by $50 and you reduce your inventory by $50. Then on October 11th, we paid the amount from the October 1st purchase less the October 7th return. And so we bought it on the 1st, we're paying it on the 11th, which means we're paying it within that 10-day discount period. So we get to take a 4% credit. Okay, so our accounts payable is going to reduce by the balance. So we had this original 1,000 less the return of 50. So our accounts payable, we're going to reduce, and in order to reduce a liability, we debit. And then our cash out the door is going to be $950 times 96%. So that's how we get to this 912. Or merchandise inventory, we're going to reduce our merchandise inventory by the credit that we took. So that's $950 times the 4% discount, or $38. Okay? All right, so then same problem here, but they're saying to assume the October 11th payment was never made, and instead the payment occurred on October 31st. Then our entry would be for the full amount, right, of what's left in our accounts payable. So we had $1,000 less a debit of 50. So we're going to debit accounts payable for $950 and credit cash for $950. Okay? All right, so analyzing and recording transactions for merchandise sales using the perpetual system. So when we're accounting for merchandise sales, we have net sales, which is equal to sales net of discounts, returns, and allowances, less cost of goods sold. That's how we get our gross profit, okay? So sales of merchandise. So each sale transaction has two parts. You would have to record the revenue and you have to record the cost of the goods you sold, okay? So let's say we make a sale without any kind of cash discount. So Z-Mart sold $1,000 of merchandise on credit. The merchandise has a cost basis to Z-Mart of $300. So we have to record two transactions. So they sold $1,000 of merchandise on credit. So on credit means we have a receivable, right? So we debit receivable and we credit sales. Well, then we also have to record the cost side of that entry. And so they tell us that the merchandise had a cost basis of $300. So we record cost of goods sold, that's an income statement account. In order to increase expenses on the income statement, we debit. So cost of goods sold, we debit for $300. And then we reduce, or we remove those goods from our inventory account. And so to reduce inventory, we credit. Okay. So just like there's purchase discounts for us as the company or the merchandiser, just as we get discounts from our suppliers, we also offer sales discounts to our customers in the same manner. Sales discounts, we're basically incentivizing them to pay us sooner than the 30-day credit period we extended them, right? So if Z-Mart were to make that sale of $1,000 with terms 210 net 45, so if they pay me within 10 days, I'm going to give them a 2% discount. Otherwise, they owe me the full 1,000 if they pay me within 45 days. So I'm going to record my initial transaction on November 12th, $1,000, right? And then I'm going to record the cost. So those are the entries from the previous slide. So let's say the buyer pays us within that discount period. They're only going to pay us 98% of that $1,000, or $980. Then, but our account receivable that we recorded was 1,000 up here, right? So we have to remove our account receivable, and we do that with a credit. And then there's a $20 discount that we gave them, which we record to a sales discounts account. Sales discounts is a contra revenue account, so it works the opposite of revenue. So revenue you credit to increase, contra revenue you debit to increase, okay? So we debit our sales discounts. So we have credit to cash, 980, debit to cash for 980, debit to sales discount for 20, and then we remove our receivable from the books with a credit of 1,000. Okay? All right, then the buyer pays after the discount period, then all we do is just record our cash and our accounts receivable. we reduce our accounts receivable. So that's an entry you're pretty familiar with, I think, from chapter 1 and 2. Okay? All right, so sales returns and allowances. So just like we as the merchandiser can return goods to our supplier, we also, our customers can return goods to us, right? So sales returns and allowances usually involve like a dissatisfied customer and the possibility of lost future sales. So, um, sales returns refer to merchandise that a customer returned to the seller after the sale, and then allowances refer to reductions in the selling price of the merchandise that's sold to customers. Let's look at how these would work. All right, so sales with returns and allowances. So let's say a customer returns merchandise which was sold for $15 and cost $9. So we're going to record sales returns and allowances at the $15 cost or the $15 sale price. And that sales returns and allowance account is similar to the sales discounts account. It's a contra revenue account, so it is increased with a debit. And we're going to give that customer cash, so our cash is going to decrease, so we're going to credit cash for 15. So if they return goods that are not defective, so this first one is the revenue side, and then the cost side depends on whether the goods they're returning are defective or not defective or not defective. If they're not defective, we're going to put them back into inventory. So we just increase our inventory and we reduce our cost of goods sold because the goods were returned, right? So that's the debit to inventory for 9 and the credit to cost of goods sold to decrease it for 9. Because when we originally sold the goods, we recorded cost of goods sold with a debit and we recorded the reduction of our inventory with a credit. And so we just have to put it back, right? But if the goods are defective, then we want to still do the same thing with our cost of goods sold, but we want to record the loss from defective merchandise. And so we're going to record loss from defective merchandise of $7, and we're going to reduce our merchandise inventory by 2. I think the assumption that they're making is that not all of the goods were defective, only some of them were defective. That's why you've got the debit to merchandise inventory for 2 and the loss from defective merchandise for 7. It's not very clear though. If they were all assumed to be defective, you wouldn't have this line here, and this would just be 9. Okay. All right, so sales allowances. So let's assume that $40 of the merchandise Zmart sold on November 12th is defective, but the buyer decides to keep it because Zmart offers a $10 price reduction. So when we offer that $10 price reduction, if we're Zmart, we're going to record a debit to sales returns and allowances. That increases that account, but it decreases revenue because it's a contra revenue account. And we're going to record cash that we give them, cash out the door, reduce our cash $10 with a credit. Okay? All right, so let's do some more journal entries. So let's prepare the journal entries to record each of the following sales transactions of a merchandising company. We're going to assume perpetual inventory system and the gross method uh, of recording that activity. So beginning inventory equals $9,000 is what they're telling us. So on June 1st, we sold 50 units of merchandise to a customer for $150 per unit credit, terms 210 net 30. FOB shipping point, and the invoice is dated June 1st. The inventory they sold had a cost of $50 per or $100 per unit. $50, so we have to record the revenue side first. So we sold 50 units at $150 each. So we're going to record account on credit, right? So we're going to record accounts receivable. So 50 units at a cost or at a sale price of $150 per unit on credit. So we're going to debit our accounts receivable and credit sales, right? $7,500. Then on the cost side, we have 50 units at a cost of $100 per unit. So we need to record our cost of goods sold, which we do with a debit. Cost of goods sold, debit 5,000. Credit inventory to reduce it for 5,000. Then on June 7th, the customer returns 2 units because it didn't fit its needs. And so they're not defective. So we restore them to inventory. So we have to unwind the sale part and we have to unwind the cost part, right? Or the revenue part and the cost part. So 2 at 150, we need to record sales returns and allowances. And then we need to reduce our receivable by $300. And then we have to undo the effect of the cost side, right? So merchandise inventory, the cost was $100. They returned 2 units, so our inventory is going to go up by $200. And our cost of goods sold is going to go down by $200. So we debit inventory and credit cost of goods sold. So here's your initial transaction, but then we return some of it, right? And then here is the cost side, but then we have to undo the cost part in this entry, okay? Right then on June 11th, the seller receives the balance due from the June 1st sale. So there were credit terms, right, of 2/10/30, I believe. And so they paid us within 10 days. So we need to record the transaction to collect the money. And so our accounts receivable balance, we started with $7,500, but we've returned $300, right? So we have a net balance of $7,200. Oops. 72. Oh my goodness gracious. This pen stinks. That's supposed to be $7,200. That's our net balance. And so that's the balance that they're paying us within 10 days. So we're going to record cash of $7,056, which is $7,200 times 98%. We're going to record a sales discount of 7,200 times 2% because we paid it within 10 days. And we're going to reduce our account receivable by $7,200. So now our balance is zero, right? And then on June 14th, the customer discovers that 10 of the units have minor damage, but he wants to keep them. So we send him $50 basically, right? So we're going to record a sales return and allowance. That's a contra revenue account. Contra revenue accounts are increased with debits. And we're going to reduce our cash with a credit, $50. Okay. All right. So if we were to look at the partial income statement, here's what would happen. We'd have our gross sales of $7,500, less our returns and allowances of $350, less our sales discounts of $144, for a net sales number of $7,006. We have cost of goods sold of $4,800, which is this $5,000 less this $200, for a gross margin of $2,206. All right, so now let's look at some adjustments that are prepared when we go to close the period for merchandising companies. Okay, so some things to know about the merchandising cost flow in the accounting cycle. So what's shown here is 2 periods back to back of the flow of merchandising costs during the period and where they're reported at the end of the period. So you purchase goods from suppliers during the period. You started the period with a beginning inventory number. The 2 of those together is equal to merchandise available for sale. And then that merchandise available for sale ends up one of 2 places. Either it's still sitting in your ending inventory on your balance sheet at the end of the period, or you've sold it and you've recognized it in cost of goods sold, which is on your income statement. The other thing to know is that your ending inventory for period 1 becomes your beginning inventory for period 2. Okay, so let's see what else is important to know here. So just as inventory is sold, it's recorded, the cost of that inventory is recorded in cost of goods sold on the income statement, and then whatever is left remains on the balance sheet. Okay. All right, so adjusting entries for merchandisers. So there's this idea of shrinkage, which is just the adjustment to reflect loss of merchandise. So if we were to record shrinkage of $250, we would reduce our inventory by $250 with a credit, and we would debit cost of goods sold $250. So when you have shrinkage or loss of merchandise, you record it just like you would if you had a sale. It's the same entry where you debit cost of goods sold and you credit inventory. So the thing to know about sales discounts, returns, and allowances, there's new revenue recognition rules that require the reporting of sales at the net amount that's expected. So there's adjusting entries at the end of the period that are required for expected sales discounts, expected returns and allowances, both on the cost and the revenue side, and we'll go through those examples. So closing entries for a merchandiser. So if you remember in the previous chapter, we talked about closing out your temporary accounts, which are your income statement accounts and your dividend account, to income summary, and then income summary to retained earnings. So the only thing that's different really here is that you've got some additional temporary accounts that would need to be closed, and that's your sales account, sales discount, returns and allowances, and cost of goods sold. Those accounts are also temporary accounts that would need to be closed in that same manner that we just talked through in Chapter 3. Okay, so the merchandising company's ledger on May 31st includes the following accounts that have normal balances, and it uses perpetual inventory system. Physical count on May 31st reveals that the merchandise inventory still available is 656. They want us to prepare the entry to record the inventory shrinkage and the 4 closing entries as of May 31st. So we put all of our accounts in trial balance form. You've got your inventory, which has a debit balance. Common stock and retained earnings have credit balances. Dividends debit, sales credit, and then all of your expenses and your contra revenue accounts debit balances. Okay? All right, so the entry for, let's see, letter A, prepare the entry to record shrinkage. So here's what's happening. We have our inventory T account that currently has a debit balance of $756. And they tell us that the inventory available for sale is $656. So how do we get from $756 to $656? Credit, right? So when we record shrinkage, we just record it through our income statement, cost of goods sold, and then we reduce our inventory balance, right? So our entry here would be to merchandise inventory to reduce it. There's our credit of 110, and the other side is cost of goods sold, 110. And then we have 656 in our trial balance, right? And our cost of goods sold goes up by 100, so now it's 2,200. Right, and so the 4 closing entries as of May 31st would be this. So all of the income statement accounts are closed to the income summary, right? So our sales has a credit balance of $4,300. So that's a credit balance. In order to close it, we need a debit, and we're going to credit income summary for $4,300. Then all of our expense and contra revenue accounts. So our sales discount has a debit balance of 50. Debit balance of 50. So we're going to credit that to make it go away. Our sale return and allowance account has a debit balance of 250. We're going to credit that to make it go away. Cost of goods sold has a $2,100 balance plus the $100 that we recorded in the previous entry for shrinkage, right? So that $2,200 debit needs a credit to make it go to zero. And then all of our expense accounts, same thing. So you credit all of your expense accounts, you debit income summary. Then the difference between so if we were to look at our income summary, call that IS. So right now we've got a $4,300 credit, and then we've got a $3,800 debit, right? Oops, $3,800 debit. So we have a net balance of $500 in our income summary. So we want to close income summary. We do that with a debit to income summary and a credit to retained earnings, which is this entry here. And then we close our dividend account, which has a balance of $150. We want to make that zero. We're going to debit it or credit it for $150, and we're going to debit retained earnings. So at the end of the day, as a result of the month of May, our retained earnings went up by 500 less 150 for dividends, so our retained earnings increased by a net of $350 when we close the period. Okay? All right, defining and preparing multi and single step income statements. So the multiple step income statement. So in the first 3 chapters, we talked about the income statement being revenues less expenses equals net income. We're not really required to use any one presentation for financial statements, but typically your merchandising companies will use the multi-step income statement. And so your first section here is the gross profit computation. So that's your sales less your contra revenue accounts, discounts, and allowances, right? For a net sales number, less cost of goods sold equals gross profit. And then from there, you have all of your expense accounts. And then there's this other section called non-operating activities computation, and then ultimately you get to net income. Okay? Whereas the single step income statement would just report all your revenues less all your expenses equals net income. Okay? All right, and then we talked about in the last chapter about the classified balance sheet. So the idea is that you report your assets from most liquid to least liquid. And merchandise inventory falls in there right beyond the accounts receivable or right behind the accounts receivable account. Okay, so inventory is usually a little bit less liquid than accounts receivable because it has to be sold before you can receive the cash, but it's more liquid than like office supplies, store supplies, prepaid insurance, that kind of thing. Okay. All right, so in this example, we're going to assume that Target's adjusted trial balance as of April 30th, 2000X1 is as follows. They want us to prepare the multi-step income statement that begins with gross sales and includes separate categories for net sales, cost of goods sold, selling expenses, and general and administrative expenses. And then they want us to also prepare the single-step income statement that begins with net sales and includes the expenses in the following categories: cost of goods sold, selling, and general and administrative. So there's our trial balance. So if we're going to prepare the multi-step income statement, we start with gross sales first, which is at $9,500, less the sales discounts and returns and allowances for a net sales of $9,000, less cost of goods sold equals gross profit. And then they asked us to split the expenses into selling and into general and administrative. So they tell us what our selling expenses are. They tell us that they're the sales salary expenses, the rent expense for the selling space, store supplies and advertising. And then your general and administrative are things like office salaries, rent expense for the office space, and then office supplies expense. Okay, if we were going to do a single step income statement, we would start with net sales. So we'll start with the $9,000. We would list our expenses in the big groups: cost of goods sold, selling, and SG&A, or G&A, sorry, for total expenses of $7,900 and net income of $1,100. So basically the single step income statement is really just a summarized version of your multi-step. Okay, so it's picking up these totals instead of all of the detail. And oftentimes when companies do this, then there'll be a supplemental schedule that will list out all of the individual SG&A expenses. All right, so a couple ratios here. So acid test and I think there's one other. So the acid test ratio is just the quick assets divided by current liabilities. Quick assets are defined as cash, short-term investments, and receivables. So the rule of thumb is that the acid test ratio should have a value of at least 1 to conclude that the company is unlikely to face liquidity problems in the future. So if we were to look at the acid test ratio for Nike, it looks like, let's see here, so it looks like they're above 1 in all of the years, although the trend is somewhat downward. They do have, let's see, compared to Under Armour, they have, well, in 13 they were way better than Under Armour by a whole point. In 14, Under Armour was 2.1, they were 1.7, so they were a little behind them. But then in 2015 and 16, they were also ahead. So if you were to look at the ratio compared to that of one of their competitors, you could say that they are less likely in all of the years except for 2014, they are less likely to face liquidity or less likely to, well, maybe I better said this way, they are more likely to have enough quick assets to cover their current liabilities than Under Armour compared to Under Armour. But all of them, all of the years for Under Armour and all of the years for Nike, it's at least 1. So you could reasonably argue that they have no foreseeable problems in covering their current liabilities. All right, and then the last profitability measure is this gross margin ratio. So gross margin ratio is net sales minus cost of goods sold divided by net sales. So it's basically the percentage of dollar sales available to cover expenses and provide a profit. And so if you were to look at the history here of Unknown Company, it looks like their gross margin ratio from 2012 through 2016 is trending upward, which is a good thing to see, right? All right, so we are not going to go through the appendix of this chapter. If you have questions or you so desire to expand your knowledge base with respect to merchandising inventory, feel free to work through the appendix in the book. And if you have questions, don't hesitate to reach out, but I don't believe you are going to have any questions related to the information that is in Appendix 4A. So in an effort to direct your efforts to the stuff that is most important and material that you will see in the homework and also on the exam, we will stop there. But if you have any questions as you're working through Chapter 4, please don't hesitate to ask. Take care, guys.